We're very delighted to announce a very good result for both Mansa-X Kenya Shilling Fund and Dollar Fund for the third quarter of this year, 2025. So the Kenya Shilling Fund for Q3 of 2025 delivered a return of 5.09%. This compares slightly lower than the second quarter of this year, which returned 6.05%, but still a very decent result. Because if you look at the 9-month annualized return, is now at 21.37%. Which is on track to actually beat last year's Kenya Shilling return, which was at 19.53 to close the year. So we think the return for this quarter puts us on track to actually beat last year's performance. The Dollar Fund returned 3.52%, but for the Dollar Fund, it actually returned a better return compared to the second quarter, which was at 3.47%. Again, the 9-month annualized return for the Dollar Fund comes to 13.51%, which is on track to beat last year's dollar performance, which was 12.5%. So we're very happy with the third quarter results because they put both Mansa-X funds, the Kenya Shilling and Dollar Fund, on just the right pace to have a better performance than we saw in 2024. So it's also very good to note, and this is something that we're happy about, that our AUM also grew significantly in the third quarter of this year. Closing the second quarter of this year, we were managing about 65 billion shillings in the Kenya Shilling Fund, but we have now closed Q3 at about 87 billion shillings. That's a growth of about 34% in AUM for the Kenya Shilling Fund. For the Dollar Fund, between Q2 and Q3, we closed Q2 managing about $79 million and have closed Q3 with about almost $100 million in management. So we are talking about a growth of 24.5% for the Dollar Fund, again, between Q2 and Q3. So this AUM growth is always important for a fund to note, because, for investors in a fund to note, because it allows us a lot more opportunities for investors that also reduce their downside risk. Sometimes if a fund is very small, there are some opportunities it cannot participate in the level that a much bigger fund can grow. So when our investors help us to grow our AUM, this is something that helps us to also invest better, essentially. We also saw the number of clients increase, and we're very thankful to our investors for this. In Q2, we had about 35,000 clients who had invested in our Mansa-X funds, and now we have about 50,000 clients who've invested in our fund. That's about a 35% increase in the number of investors with us, and we're very grateful and we appreciate this. Third quarter of this year turned out largely as we expected. As I'd mentioned in Q2, we expected a normalizing of the fears around tariffs, which is exactly what happened. So one of the things we noticed was there was a rotation back to American markets. In Q1 and Q2, we had seen some jitters around US markets. So we had seen a lot of capital moving to the continental Europe. But in Q3, we saw again capital coming back because there was seen to be a lot more comfort in the resolution of concerns around tariffs, except of course China. We still have concerns around there. We have some deadlines for some decisions in November, but largely the concerns for tariffs were subdued enough to actually cause the markets to rally. The other thing that actually encouraged markets to rally was the AI sector. This has continued to do very well, has continued to pull up not only just companies related to AI, but also companies that support AI. So we are talking about energy companies, as I mentioned even in previous videos, about companies like Vistra, which are in the nuclear energy space. These companies provide energy for AI providers. So these companies continue to see a lot of growth. We saw also, companies that are in the utility space, the ones that build data centers. These continue to be very critical to the AI infrastructure. So we also saw a lot of growth in that area, and we expect to see a lot of growth continuing there. Oracle is the one company we would want to mention because it has been one of the biggest beneficiaries of the AI growth. And we expect that it will continue to really benefit from this AI-driven growth. And for AI, we feel that it's genuine growth compared to, say, because a lot of people wonder and have been asking us whether there is a comparison between the AI growth, market growth compared to what we saw with the dot-com bubble. We feel that this is actually a paradigm shift in how things are done. So we feel that it's something that is actually sustainable in terms of how this will continue to impact markets positively. On a monetary policy side, we saw our first rate cut in September, which was about 25 basis points. We expect that we might see another rate cut before the end of the year. But again, this rate cut again contributed to the rally in equities, but also overall for the bond markets as well. So you also saw bond markets rally considerably. And this was not just for global bonds. We are also talking about Eurobonds, African Eurobonds. As you know, we also participate in African Eurobonds quite a bit. We saw a rally in Eurobonds because of a rate, because of a cut in these interest rates, but also because of the overall risk on sentiment globally. So Eurobonds tend to be affected by those two factors, and this time they were both positive for Eurobonds. In fact, Eurobonds actually rose by in excess of 20% in valuation for Q3 alone. That's quite significant compared to stocks, which if you look at global stocks, the S&P alone gained about 8% for Q3, and that's still a very significant number. So you had a rally in stocks, you had a rally in bonds, and not just globally, but also locally. If you look at the NSE, the NSE All-Share Index was actually up in excess of 40% for Q3. That's massive. And we are very happy to see this because there's a renewed confidence in local markets as well. And we expect that this will continue, mostly driven by banking stocks. And we expect that this trend will continue. In Europe, there were no rate cuts in Q3. And we also saw concerns around political turbulence, especially in France. In fact, the number that's coming out is that France lost about 0.2% of its GDP growth estimates due to political turbulence. That's how bad it was in France in Q3. And across Europe, we actually saw weaker economic data. And in fact, even the biggest economy, which is Germany, is actually in stagnation mode. So a lot of pessimism out of the European continent. So from a currency perspective, we saw a weaker dollar in Q3. And as a result of having a weaker dollar, it actually pushed a flight to safety into metals like gold and silver. So it's a massive rally in gold and silver, mostly buoyed, of course, by the weaker dollar and flight to safety. But also, we also saw central banks actually buying gold in the market. The biggest buyer was Poland, followed by China, India, and Turkey. But even our very own Central Bank of Kenya actually increased their gold holdings as well. So that's also interesting to note. I'll go through the top 10 holdings of the fund, and just again, I always remind our investors that this is available on the fact sheets that we share at the end of every quarter. So as you're receiving your statements from your financial advisors or relationship managers, always ask them for the fact sheet as well. It has all this information in more detail. And for clarification, when we say top 10 holdings, we mean the assets in terms of the individual percentage compared to the overall fund. What they were actually, how much the fund was actually holding in this particular asset classes, and why they're in the top 10 is because they are really the 10 largest. But outside of the 10, these funds can easily have about 200 to 250 other individual stocks outside of these top 10. So these are just the ones we highlight because they were significant in their percentage proportions to the entire fund. So for the Kenya Shilling Fund, the top two assets were related to fixed income instruments. So here, of course, we are talking about government bonds, Euro bonds, US treasuries, and so on. As I mentioned earlier, because of a lowering of interest rates, we actually saw a rally in bonds. Of course, the most significant was Euro bonds, where we saw Euro bonds rally in excess of 20% in that small period of Q3. That's quite significant, and we expect that this will continue towards the rest of the year. The rest of the top holdings were actually largely related to the rally in AI, as I had mentioned. The Nasdaq was up about 9%, and this was our third top holding. Alphabet is a holding company of companies like Google, was up about 38%. Nvidia, which is a maker of chips and is actually now the most valuable company in the world, was actually up 18% in Q3. Again, a big beneficiary of the surge in AI-driven growth. Oracle, again, as I mentioned earlier, continues and is expected to continue to benefit from the AI wave, was up almost 30% in Q3 alone. Taiwan Semiconductors Manufacturing Companies, what we like to refer to as TSMC, was actually up about 23%. And then we had silver futures. So as I mentioned, metals really benefited in Q3. So gold and silver were the biggest ones. In this case, in the Kenya Shilling Fund, we were holding silver futures, and they were up almost 30%. Caterpillar has actually really benefited in Q3 due again to AI growth, but also it's really benefiting from the downstream growth of building data centers and so on, but also from the onshoring policy by the Trump administration, where it's all about grow and build America. So Caterpillar is a big beneficiary of that, and the stock jumped in excess of 23% in Q3. The dollar fund, the top 10 holdings are very similar. They're very similar to the Kenya Shilling Fund. If you look at the third top holding was S&P 500, which is up almost 8%. Nvidia, Broadcom, Alphabet, Oracle, those are very similar to what we had in the Kenya Shilling Fund, of course, except Broadcom, but that's still in a very similar field as Nvidia. The only exception here is Palantir. Palantir is more of a defense stock. We still think that defense stocks will continue to do well, especially as we see an increase in defense budgets globally, with increased geopolitical concerns and uncertainties, especially in Europe, where you first have the uncertainties and then more concerns about the fact that you might not be able to rely on Big Brother America. So allocations to defense has actually increased significantly. So stocks like Palantir are doing very well. In Q3, we actually saw Palantir jump about 33%. That's quite significant for that small period. Gold, here we actually invested by proxy. So sometimes we don't actually buy gold directly. We can buy ETFs for gold service providers. In this case, we have an ETF we're holding here called the VanEck Vectors and Gold Miners ETF, which was up almost 50% in Q3. You can imagine that's quite a jump for one ETF. Again, that was our number 9 top holding. In terms of geographical distribution, you'll see the fund increased its holdings in the Americas. We were up to almost 50% of the fund being in the American region. Europe was the second largest at about 30%. Then we had Africa, Middle East, and Oceania. Africa is mostly because of the local stock holdings we hold, as well as Eurobonds. Then for the dollar fund, the US market was actually above 50% at 53%, Europe at about 30.5%, then Africa, Asia, and Oceania at about 15%. So again, this geographical distribution is also another way that we actually diversify this fund. So we diversify our investors' contributions by being in different companies, different asset classes that are uncorrelated, and also invest in funds in different geographical locations, meaning that at any one time, an investor's $1 is spread out over very many different parameters. So now we are just looking to close the year positively. This is the last quarter of this year, but we're very optimistic. We still think markets will continue to rally. There are a lot of pointers to this direction. The first one being that we expect another rate cut in Q4. In fact, it's all but certain we might get a rate cut this month of October, and maybe another one in December. So having rate cuts will continuously help to prop up markets. So again, this will keep, which is expected to keep the stock market rally on. Of course, the biggest concern right now is the fact that we have a government shutdown in the US. This means that there's a stalemate in terms of spending. So this can affect the way we are able to receive data. So a lot of the data that is used for trading, things like non-farm payrolls, CPI data and so on, we receive from government agencies, which are now not functional because of the government shutdown. So that can affect a bit of decision making, not just for funds, but even the Federal Reserve itself. But again, if you look at it from a historical perspective, markets have tended to ignore shutdowns. This has happened before, and markets did not quite react to them in any manner. So we expect that this will not be any different. The biggest thing for us will just be to look at companies that we are invested in and how their earnings come out. We expect that the consensus for most companies is a growth in earnings by about 8% this quarter. So again, this is very market positive. From a geopolitical perspective, we expect that tensions between the US and China might revive concerns around tariffs. But we've also noticed that both sides now are very careful because, of course, it's become very clear to them how conversations around tariffs is actually creating tensions in markets. So we expect that they will also be a bit more gentle in how they approach their rhetoric around tariffs. Again, geopolitically, at least now we have seen a ceasefire between Israel and Gaza. So we expect that this will be will create a lot more stability globally, and this, of course, tends to be market positive. We are still left with Russia and Ukraine, which again, we seem to be seeing some progress on that end, but we are still very bullish on defense stocks. Even in terms, even if you're getting a more normalization of geopolitical tension, we remain bullish on defense stocks because of military spending increase, especially in the European continent and Canada. So for the EU, defense spending as a factor of GDP is at about 2.3%. They are now doubling that to 5%. That's quite significant. So we'll expect that a lot of defense stocks will continue to rally into Q4. In terms of metals, gold and silver, gold is now trading at an all-time high, above $4,100 an ounce. These are really high level, but we still think that gold has a potential to actually reach $5,000 an ounce. So we still think that gold is a good asset to hold, and silver as well. Locally, we expect that interest rates will keep coming off. We saw the CBK cut rates, and we expect that rates locally will continue to come off, meaning that we might see a rally in bond prices, but also the local stock market will continue to be very well supported. Especially for in the Eurobond side, we saw the government tender for the 2028 paper and offered two new bonds, the 2033 and 2038. This was mostly to alleviate short-term debt obligations and also for budgetary support. And this has seen a lot of interest in the market. So a lot of factors that played into Q2, Q3 are expected to continue into Q4. But the most important thing is to note that because of how we trade this fund, in spite of any shifts unforeseen changes within markets or geopolitically, this fund is able to adapt very quickly. Again, because we use a long short trading model, which means that in any asset class that we enter into, we can quickly change it from a long position, meaning we benefit when prices go up, to a short position, meaning that if prices are coming off, we could still benefit from that move. So this fund continues to be very nimble, and in spite of what happens in markets, we are still well positioned to deliver alpha returns for investors, even as we go into closing the year. I'd want to take this opportunity to thank our investors who have really supported us in the Mansa-X funds. We really appreciate where we have come from and where we are. We now have about 50,000 of you who really believe in the product and have invested with us. We are now managing in excess of 105 billion shillings in assets under management. We really appreciate, and we don't take this for granted. We do everything we can, and we'll continue to do everything we can to ensure that our investors not only have returns that beat market averages, but also make sure we don't expose clients to undue and unnecessary risks, and do whatever we can therefore to keep the upside higher than any possibility of the downside. SIB this year is also celebrating the 30th year in existence, so we're actually celebrating our 30-year anniversary, and we'd like to ask our investors to join us as we continue to celebrate this. None of this would have happened without the support we receive from our investors, and we really look forward to continuously delivering more and more returns for investors and even better products that again align with our investors' needs. One of the things we have heard from our investors is, can you have other currencies in terms of funds that you offer us? That's something we are considering. We also heard you about the need for a mobile application. We are working tirelessly to deliver on this request as well. We also have questions around operational efficiencies, and we also want to assure investors that we are doing everything we can to make sure that we become better, not just in the returns that we give our investors, but in terms of the efficiency with which we serve you as our investors. So once again, thank you very much, and we look forward to an even better fourth quarter of this year. Thank you.